Welcome everyone. I'm back with the second video on Goodwill valuation, and we will talk about the capitalization method today. Under the capitalization method, there are two sub methods. First one is capitalization of average profit and second one is capitalization of super profit. First, we'll talk about capitalization of average profit. I'm sure you're watching the videos and you're getting benefited by it. I'll soon come with other videos also. Keep watching my channel. Don't miss any of my lectures. So let us first understand what do you mean by the capitalization method. Capitalization means how much capital is required to earn a particular amount of profit. Now supposing a company wants to earn a profit of 1 lakh rupees and the normal rate of return of this type of business is 10%, the company would have to invest a minimum of 10 lakh rupees to earn a profit of 1 lakh. Why? Because 10% of 10 lakh is 1 lakh. Okay. Now, when we are using the first method, that is capitalization of average profit, there are certain steps to be followed. The first step to be followed is to calculate the capitalized value of the average profit. Generally in a sum, the average profit is already given. But however, if the average profit is not given, first we have to calculate the average profit. And I'm sure you know how to calculate the average profit. We'll do the total of the years of profit which has been given to us. It may be 3 years profit, it may be 4 years profit. We'll do the total of the profit and divide it by the number of years. Supposing it is 3 years profit, so we'll divide it by 3. Supposing it is 4 years profit, we'll do the total and divide it by 4. So then we'll get the average profit and we'll find out the capitalized value. How do you do that? The formula is average profit into the reciprocal of the normal rate of return. Now what do you mean by reciprocal of normal rate of return? 100 by the normal rate of return. Is it clear? So this is the first step which has to be followed, where we find out the capitalized value of average profit. The second step is to find out the net asset or capital employed. Now, how do you do that? There are two formulas. Number one, total asset minus outside liabilities, okay? Or if you are given the value of capital account, current account, reserves and surplus and profit, that will be added to find out the capital employed. There are two methods with which the capital employed can be calculated, which we'll see when we do the sums. And the third step is to ascertain the goodwill, and that step is goodwill equals capitalized value of average profit minus net assets. Now let us solve some problems. Assets of a firm was valued at 12,50,000 and the liabilities was 3,50,000. The normal rate of return is given as 10%. The actual average profit is already given to us as 1,20,000. We are supposed to calculate the goodwill according to the capitalization of average profit. So you can see the informations which are given to us. You are given the value of assets, the value of liabilities. Subtracting them will give you the value of capital employed. Here you are already given the amount of average profit, so you don't have to calculate the average profit, and you are given a normal rate of return as 10%. So step 1, we'll calculate the capitalized value of average profit. See very carefully, 12 lakh into 100 divided by 10, that is reciprocation of the percentage of normal profit, that is 10%. So we require 12 lakh rupees to earn a profit of 1,20,000 at 10% return. This is the first step. What is the first step? Calculation of capitalized value of average profit. Second step is to calculate the capital employed, and it is very simple over here because the value of assets and liabilities both are given. And we will subtract the value of assets and liabilities. You can see very carefully 12,50,000 is the value of assets and 3,50,000 is the value of liabilities. If we subtract that, we get a value of 9 lakh. And after we have got these two values, that is 12 lakh and 9 lakh, we will calculate the goodwill using a very simple formula, that is capitalized average profit minus capital employed, which will give you 12 lakh minus 9 lakh, that is 3 lakh, and the goodwill is 3 lakh in this case. Now let us take another problem. In this case, we are given the capital balance as on 1st April 2019 of X and Y, who are the partners of the firm, and their capital balance is 1,80,000 and 1,20,000 respectively. The balance of general reserve is also given as 60,000, and the profit of the last 4 years are given to us. 66,000 was the profit for the first year, 72,000 was the profit for the second year. There is a loss of 16,000 in the third year, and there is a profit of 18,000 in the fourth year. So we are given last 4 years profit, and out of which 1 year there is a loss of 16,000. The normal rate of return is given as 8%. See very carefully over here, we are not given the value of assets and liabilities, so we have to take the sum total of the capital invested by both the partners X and Y and the total of general reserve to calculate the capital employed. Moreover, in this question, the average profit is also not given, so we have to calculate the average profit. Please see very carefully, we have done that first step, that is calculation of capitalized value of average profit. First, we have found out the average profit. How did we do it? 66,000 plus 72,000 minus 16,000 plus 18,000 has given us a total of 1,40,000. This has been divided by 4 because we are given 4 years profit and loss, and we get 35,000 as the average profit. Here the normal rate of return is given as 8%, and therefore we have tried to find out the value of the capitalized value of average profit by using the formula average profit into reciprocal of normal rate of return, that is 35,000 into 100 divided by 8. The normal rate of return is 8%, you can see very clearly. So we are getting the capitalized value of average profit as 4,37,000. This is step number 1. Now let us move on to step number 2, where we will calculate the capital employed. Here the capital employed will be the sum total of the capital and general reserve, and that will be 1,80,000 plus 1,20,000 plus 60,000. That will give us a value of 3,60,000. Now we have two numbers over here, that is the capitalized value of average profit 4,37,500 and the capital employed 3,60,000. We will deduct both and find out the goodwill. You can see very clearly 4,37,500 minus 3,60,000 is giving us the goodwill 77,500 in this case. Now let us go on to the next method. The next method is capitalization of super profit. Here there are 4 steps to be followed. Step number 1, calculate the average profit. How do you do that? That is total profit divided by number of years of profit. Second, calculate the normal profit. The normal profit will be calculated using the formula capital employed into normal rate of return. Step number 3, calculate super profit. What is super profit? Super profit is the excess of normal profit over the average profit. You can see very carefully that average profit minus normal profit is giving you super profit. After the super profit is calculated, the percentage of profit is reciprocated to find the value. Okay, the percentage of profit is reciprocated to find the value. So over here, goodwill is not a subtraction, it is a direct calculation of the super profit. Once we have got a super profit, whatever the rate of normal return is, we'll do the reciprocation of that to find out the goodwill. So you can see the formula, goodwill equals super profit into 100 divided by the normal rate of return. To understand the concept of super profit capitalization, let us take the help of 2 examples. Now the first example which I have taken over here, I have taken the total profit of the last 3 years as 1,80,000. The capital employed was 4,50,000. The normal rate of return is 10%. Calculate goodwill valued at capitalization of super profit. So here we have taken the total of last 3 years of profit, which is 1,80,000. We can easily find out the average profit, that is 1,80,000 divided by 3 is giving us 60,000. Second step is calculation of super profit. For that, First we need to calculate the normal profit, and we can easily do it because the value of capital employed is directly given to us and the rate of return is also given to us as 10%. So we have calculated 10% of 4,50,000, which is coming to 45,000. Therefore, the normal profit is 45,000 and the average profit is 60,000 as it is calculated already. So 60,000 minus 45,000 gives us a super profit of 15,000. Now we are calculating goodwill on the basis of super profit using the formula super profit into 100 divided by normal rate of return, or super profit into reciprocation of normal rate of return. So 100 divided by 10, that is the reciprocation. 15,000 into 10 divided by 10 gives us 1,50,000. So the goodwill of the firm is 1,50,000 in this case. Now let us take another example to understand the concept of capitalization of super profit. See, we have taken the capital balance 3 lakh, profit of the last 4 years 52,000, 40,000, 66,000 and 46,000. Normal rate of return is taken as 12% and we are asked to calculate goodwill on the basis of capitalization of super profit. Now see very carefully the steps. Step number 1, calculation of average profit. Why we need to calculate? Because it is not given to us. And how do you calculate it? We do the total of the last 4 years profit, that is 52,000 plus 40,000 plus 66,000 plus 46,000 divided by 4. So 2,04,000 divided by 4 gives us the average profit as 51,000. Step number 1 completed. Step number 2 will calculate the super profit, and we know the formula of super profit, average profit minus normal profit. Here we have already calculated the average profit as 51,000. So the next step is to calculate the normal profit. The normal profit, as we know, is capital employed into normal rate of return. Here the capital employed is already given to us as 3 lakh. We can see that, and the normal rate of return is given to us as 12%. So 3 lakh into 12 by 100 gives us 36,000. So we have two datas now. That is the average profit 51,000 and the normal profit 36,000. And when we subtract 51,000 and 36,000, we get 15,000. This is our super normal profit or super profit. Now, on the basis of 15,000, if we calculate goodwill using the formula super profit into reciprocation of normal rate of return or super profit into 100 divided by normal rate of return, we get 15,000 into 100 divided by 12, which gives us a value of 1,25,000. So in this case, the value of goodwill will be 1,25,000. With this, we complete the goodwill valuation. Keep watching my videos. I'll soon come up with new videos of the other chapter.